Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a major market divergence sets the stage for a battle at the bell. Futures are torn as AI's fortress masks deep cyclical weakness. Will tech surge continue, or will yesterday's industrial bloodbath spread? Second, a king is dethroned. Alphabet surges past Apple in a historic reversal. AI power play rocks Wall Street. For the first time since 2019, Apple is no longer number one. Is this the start of a massive capital rotation into AI victors? And will Apple's stock face a reckoning at the bell? Finally, Blackstone tumbles 6%. Trump's shock ban on corporate home buyers ignites real estate bloodbath. The proposal has ignited a firestorm, but the real shock is the hidden paradox. Could a ban designed to lower home prices actually cause rents to skyrocket and trigger a new inflation crisis? Warning! Yesterday wasn't just a red day for the Dow, it was a distinctive crack in the cyclical recovery narrative. While the Nasdaq held its ground, the industrial heart of the market took a beating, signaling a massive rotation under the surface. The divergence we are witnessing is not random noise, it is a calculated repositioning by institutional capital facing a complex economic reality. The divergence is stark. The S&P 500 finished effectively flat at 6,920, and the tech-heavy Nasdaq Composite managed a 0.16% gain, continuing to show resilience. But the real story is the Dow Jones Industrial Average, which shed nearly 1% or 473 points. This marks its worst single-day performance in weeks. The market is bifurcating. Capital is fleeing economic sensitivity and seeking refuge in secular growth fortresses. Why is this split happening now? The catalyst was a brutal 1-2 punch from labour market data released yesterday morning. The JOLTS report showed job openings plunging to a 14-month low of 7.146 million, significantly missing expectations. Simultaneously, the ADP employment report showed private sector payrolls added a meagre 41,000 jobs. This data signals that corporate America is rapidly cooling its hiring engines. Investors immediately punished companies tied to the physical economy. The logic is straightforward. If hiring slows, capital expenditure and consumption follow. This is why the industrial sector was the day's biggest loser, with bellwether Caterpillar dropping over 4%. Financials also retreated, with JP Morgan and Bank of America both down over 2%, as the market priced in potential credit headwinds from a softer labour market. However, the situation is complicated by the ISM Services report. While the headline number showed expansion at 54.4, the prices paid component surged to 65.4. This creates a nightmare scenario for the Federal Reserve. Slowing labour demand, but sticky, persistent inflation in the services sector. The market is now grappling with a higher for longer reality where the Fed cannot rush to rescue the economy with rate cuts without risking an inflation resurgence. Consequently, the CME FedWatch tool shows the probability of a January rate cut has collapsed to just 16%. Amidst this macro gloom, the AI narrative provided a critical lifeline for the technology sector. Alphabet surged 2.5%, briefly overtaking Apple in market cap to become the world's second most valuable company. The driver was a report that Meta Platforms is in advanced discussions to rent Google's custom tensor processing units, or TPUs, for its AI infrastructure. This is a massive validation of Google's vertical integration strategy and suggests that the AI capital expenditure boom is entering a new collaborative phase. Even Intel found buyers jumping over 6% following promising product announcements at CES. Conversely, the real estate sector faced a sudden political shockwave. President Trump announced via social media that he intends to ban large institutional investors from purchasing single-family homes. The market reaction was swift and violent. Home builders like D.R. Horton fell 3.6%, and major landlords like Blackstone tumbled 6%. While analysts point out that institutional ownership is a small fraction of the total housing supply, the market is aggressively repricing regulatory risk in the housing sector. The market rhythm has shifted. We are seeing a defensive rotation into quality growth companies with strong balance sheets that can grow regardless of GDP, and a rejection of cyclical value. The market is now holding its breath for the final piece of the puzzle, Friday's official non-farm payrolls report. If the data confirms the weakness seen in ADP and JOLTS, the rotation out of cyclicals could accelerate. The divergence between the Dow and Nasdaq suggests the era of broad-based rallies is pausing. Stock selection based on earnings quality is now the dominant theme. The story begins with a decision that has been years in the making. Heading into today's open, a 5-year reign has ended. For the first time since 2019, Apple is no longer the most valuable company in the world. Google's parent company, Alphabet, has officially knocked Apple off its throne. Now, get this. This isn't just about two tech giants swapping places. This signals a fundamental shift in how the market values companies. We are entering a new valuation regime where a company's perceived AI strategy is becoming the primary driver of its stock price. A while back, we analysed how an AI shock premium crept into tech valuations and how the fear gauge, the VIX, can jump on any wobble in US tech leadership. The latest development is that this premium is now being expressed in who leads the market cap tables, which could trigger a broad reallocation of capital away from companies with an unclear AI roadmap and into a concentrated group of perceived AI winners. Ahead of the bell, the numbers tell a dramatic story. Alphabet's market capitalization now stands at a staggering $3.88 trillion, pushing past Apple's $3.84 trillion. Continuing our last discussion on the AI capex supercycle, where hyperscalers kept accelerating spend, today's flip at the top fits the same pattern. Capital is rewarding the firms seen as building and owning the AI infrastructure. The situation presents a fascinating duality. On one side, you have Alphabet, which saw its stock rocket up 65% last year, its best performance since 2009. The company has been on an AI offensive, unveiling its powerful Gemini 3 model and new custom Ironwood chips that are emerging as a challenger to NVIDIA. We previously noted that hyperscalers like Amazon, Google, and Microsoft are in an arms race on AI infrastructure. Alphabet's momentum isn't happening in isolation. It's riding that same structural wave, even as power constraints and the end of ever cheaper compute keep pushing capex higher. So the thing is, the key here is that Alphabet is creating its own custom AI chips, known as tensor processing units or TPUs. For years, NVIDIA's GPUs have dominated the AI industry. But by designing its own silicon, Alphabet can create hardware perfectly optimized for its software. Research shows Google's latest TPUs are not only faster, but also significantly more energy efficient than some of NVIDIA's top chips. This strategy of vertical integration, controlling both the hardware and software, creates a powerful competitive advantage. As we've discussed before, US export controls have created a compute ceiling for China. So while Alphabet's approach provides a tempting template for others trying to build self-sufficiency, those constraints remain a real limiter on how quickly that playbook can be copied. Alphabet CEO Sundar Pichai noted the company signed more billion-dollar-plus cloud deals in the first 3 quarters of last year than in the 2 prior years combined. That dovetails with what we flagged a while back. The AI build-out has become a primary engine of demand, with data center power needs rising and budgets expanding even when model narratives wobble, supporting durable spend by the biggest buyers. On the other side is Apple, which has been described as largely absent from the AI race. Actually, Apple is making a very different strategic bet. While companies like Google use powerful cloud-based AI, Apple is focused on a privacy-first, on-device approach. This means processing AI tasks directly on your iPhone, which is faster for simple tasks and protects your data. However, it also limits the sheer power and complexity of the AI because it can't tap into massive data centers in the cloud. This is a critical trade-off we've highlighted before in the broader cloud versus device debate. The company delayed its next generation Siri Assistant, pushing its release into 2026. This lag is not going unnoticed. The Wall Street firm Raymond James just downgraded Apple stock, warning that gains will be hard to come by this year. This reversal sets up a major battle for investor sentiment as trading begins. You know, the widening valuation gap between AI leaders like Alphabet and the rest of the market isn't just about stock prices. It's a real-time measure of Wall Street's bets on future AI-driven productivity. We previously mentioned that such leadership gaps can also amplify concentration risk and volatility. Watch for any unusual spikes in the VIX as a tell on that underlying anxiety. And remember, if profits don't keep pace with the investment tsunami, that's the classic setup for bubble risk. Watch for whether Alphabet can extend its lead at the open, fueled by its AI momentum, while Apple now faces mounting pressure to prove it hasn't been left behind in tech's new frontier. At the open, look for whether capital continues to flow out of Apple and into Alphabet, potentially impacting the performance of the entire NASDAQ 100 ETF, known as QQQ, which tracks the largest tech companies. Also keep an eye on the fear gauge if we see a pop there. It would echo what we've discussed before about the market sensitivity to shifts in perceived American tech leadership. The big question is whether consumers and investors will continue to value Apple's ecosystem and privacy, or if the raw power of AI becomes the new deciding factor. Speaking of major market shifts, let's pivot from the digital world to the physical one. A political bombshell is rattling the housing market and putting Wall Street on high alert. Former President Donald Trump has announced a plan to ban large corporate investors from buying single-family homes, a move aimed directly at private equity's multi-billion-dollar real estate empires. But that's not the whole picture. The real turning point is that this proposal sets a powerful populist precedent for market intervention. However, if you zoom out, you'll see another layer of strategy at play. By targeting a specific class times of investor, it creates a template that could be used against other industries dominated by large firms, from big tech to private credit. This forces investors to price in a new kind of political risk, one that's different from, say, Canada's broader foreign buyer ban, which ultimately had very little impact on prices. So at the open, watch for a ripple of concern beyond just real estate stocks. The market's initial reaction was swift and brutal. The news yesterday sent shares of some of the biggest players in the space tumbling. Blackstone, one of the largest private equity buyers in the world, fell more than 5%. Invitation Homes, a company that owns and rents out tens of thousands of single-family houses, plunged 6%. This is where the situation takes a more complex turn. This ban directly threatens the booming build-to-rent industry. This is a key source of new housing supply where homes are built specifically for institutional rental. In fact, an astonishing 94% of single-family homes started in the second quarter of 2025 were built for rent. A ban could dismantle this pipeline, hurting home builders who have built entire business models around it. Heading into the open, look for potential weakness not just in private equity, but also in home builder stocks like Lennar and DR Horton and the broader home builder ETF, ticker XHB. The proposal draws a clear battle line, with Trump stating, people live in homes, not corporations. This move is designed to address voter anxiety over housing affordability, but it ignites a fierce debate over who is really to blame for high prices. Believe it or not, the outcome could be incredibly complex. A forced sale by these giant landlords could flood the market with homes for sale, but it would also shrink the available rental housing stock. This decision brings both potential benefits for home buyers and comes with inherent risks, creating a paradox. Home prices could fall, but rents could actually spike higher. That could complicate the Federal Reserve's inflation fight, keeping the shelter component of the consumer price index stubbornly high even as the housing market cools. When we place Blackstone's claim alongside the Urban Institute's research, the contradiction becomes clear. We're seeing Blackstone claim institutions own a tiny 0.5% of all single-family homes in the US, while at the same time, independent research from the Urban Institute suggests that figure is closer to 4% and much higher in specific high-growth cities. This discrepancy is at the heart of the fight. Interestingly enough, both sides could be technically correct, and it highlights a crucial point. The impact isn't uniform. While the national ownership percentage may sound small, the concentration in certain hotspots is massive. For example, in the Atlanta metro area, research shows institutional investors own about 25% of all single-family rental properties. So while a ban might not move the needle nationally, it could cause major dislocations in specific Sunbelt cities, creating a fragmented market with very different outcomes from one city to the next. Some analysts are already questioning if a ban would even work. The chief economist at Redfin cautioned that if big investors are forced out, they might just be replaced by mid-sized investors, not the first-time home buyers the policy aims to help. That reminds me, a ban on one asset class doesn't make the capital disappear, it just redirects it. This could trigger a capital reallocation shock, where billions of dollars previously aimed at single-family homes now flood into other real estate sectors. This could create bubble risks in new areas like multifamily apartment buildings or even commercial real estate. We've already seen firms like Blackstone make huge bets on apartment communities, so this policy could dramatically accelerate that trend. This all sets up a major test for these stocks ahead of the bell. The question is whether yesterday's sharp sell-off was a knee-jerk reaction or the beginning of a fundamental repricing of Wall Street's bet on the American home. watch for continued pressure on real estate and private equity names as the market opens. At the open, look for how traders are positioning not just in Blackstone, ticker BX, and Invitation Homes, but also in that home builder ETF, XHB. The key will be to see if the selling pressure broadens or if capital begins to visibly rotate into other real estate sectors like multifamily REITs.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.